I think if you look at the entire crypto universe, you have a lot of different creatures. You have crypto commodities, you have crypto securities, you have crypto exchanges, you have cryptocurrencies. And then you have a set of applications and protocols that interlace with all of these instruments. And what you have is a bunch of people in the ecosystem that don't necessarily understand or have the information to make the best decisions. And you have a lot of people outside of the ecosystem that are afraid to enter the ecosystem because they don't have the clarity they need.
Everything is hard before it's easy. The crypto market has taken a nosedive in recent weeks, with the value of Bitcoin and other cryptocurrencies plummeting. And all this has caused a great deal of panic on social media and Wall Street, where investors have lost billions of dollars. But Michael Saylor seems to have kept his cool amid all this crash. In today's video, I'm gonna cover why Michael Saylor still believes in Bitcoin despite the crypto crash. So what are we waiting for? Let's get into the video to know why he believes that this crypto crash might be a good thing in the long run.
This crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And we saw last week, Tether had to redeem billions and billions of dollars of Tether. And they could, right? So they could. But if you'd actually tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. So I think the industry got educated.
Saylor has put a positive spin on the recent crypto market crash. To know more, stay tuned to the last. And if you're new to my channel, be sure to subscribe and hit that bell icon.
Not everything is equal, right? There are 19,500 things, on coin market cap, but they're not all equal. So to say, well, this is risk-free or that is, like they all have different flavors of risk, but how do you assess the risk? So I think that the industry is getting more sophisticated. I think that the regulators now have some pressure. The Secretary of the Treasury was in a congressional hearing with Senator Toomey. And he's been an advocate of some stablecoin legislation. And he asked her, you think we need to get it done this year? And she said, yeah, I think we can and should get it done this year. So the consensus among the regulators and the politicians is, yeah, we probably need to do this. Now, you could say, if you're the crypto anarchist, I hate regulators. I don't want them to do anything. Well, that's one way to view it. But as long as they don't do anything, the industry stays $1 trillion, $1, $2, $3 trillion. When they do something, then you're going to see people like, let's say David Solomon was on CNBC. If I speak to CEOs of publicly traded companies and banks, like publicly traded banks, they'll say, our regulators won't let us. So you see the conundrum here, which is, you can either stay in a regulatory gray zone or you can create a clear public policy framework. And then you move into this compliant zone. And when Goldman Sachs and JP Morgan enter the space, they'll issue $500 billion of stable coin, trillions of dollars. And so you'll go from 150 billion to 1.5 trillion. And when they start issuing in that size, you'll see Amazon and Google and Microsoft using stable coin for international remittance and corporate remittance. And then you'll see it get built into Apple Pay and Google Pay and Amazon as a payment method. The regulators need to provide more clarity on this issue of stable coins. And they also need to provide more clarity on the requirements for a crypto security.
So Michael Saylor believes that this entire crypto crash is actually really good. It's educating the world in the difference between Bitcoin and security tokens, and that's going to facilitate the entry of institutions into this space. Let's hear more from Michael Saylor.
I think that when you're looking at modeling this, you have to be aware of timeframes. for example, I mean, a lot of people, they want to read a headline and then they want the price of the asset to move the way they want it to move immediately or the very next day. But in fact, there are very long time delays in these things, 6 months, a year, 2 years, 3 years. So I think that as I pointed out, if you look at the 2-year, the 4-year, the 6-year time frame, Bitcoin is acting very rationally per inflation. But if you look at very short time frames like 6 weeks, you may sometimes get the opposite of the expected effect in the near term, because you've got other drivers. You have traders that have large pools of capital that are trading with a different model that are dominating the market in the near term.
While crypto crashing may be bad news for investors who have seen their portfolios take a hit, it could ultimately lead to more stability in the cryptocurrency market, as well as lead to the entry of big institutions in the crypto space. He points out that regulators need to bring clarity soon.
I think if you're going to invest in the asset, you have to have a clear idea. Are you a trader or are you an investor? If you're an investor, you have to have a 4-year time frame. Mm-hmm. And then you can only start to make conclusions after you've waited a couple of years. If you're a trader can make conclusions faster. You just look at the correlation. You say, well, NASDAQ traded down 2% today. Did Bitcoin trade down 2% or 4% or 1%? And you're building these back-tested correlated models. And I suppose that works fine. But again, I just think that they're just not intellectually defensible over the long term. Like, for example, the Titanic hit an iceberg. Everybody ran to the deck. Okay. The Titanic sailed into the sunshine and it's a beautiful sunny day, 75 degrees. Everybody came to the deck. Okay. So you've got a statistical model. Everybody runs to the deck. You say, oh, the sun must be shining. It's a great day. Or you built your model and you say, oh, everybody ran to the deck. We must have just hit an iceberg. But you see, at the end of the day, it does matter whether or not you hit the iceberg or not, or whether the sun is shining. And the statistical model won't tell you the difference between the one or the other. Both of them have a lot of people standing on the deck of the ship. Right. And so I just think you got to think more fundamentally about these things. I mean, not too many people are thinking about the fundamentals, at least in the near term. I joked on Twitter, people with less knowledge and more money than you set the price in the market. Over time, they will get the knowledge, you will get the money.
It's true that most of the time, when we check a headline, we want the prices to move that way. But that is not how markets work. Granted, there are times when headlines cause prices to swiftly move immediately. But that mostly happens with short time frames and due to other drivers. According to Saylor, if we look at long time frames, like 2, 3, 6-year time frame, Bitcoin is reacting rationally to inflation. Let's see what else he has to say on this. But before going ahead, if you're enjoying the video, don't forget to give a big thumbs up.
Over time, what really matters is the underlying fundamentals, right? And in the near term, you have panics. And the panics cause like risk-off events. Like people panic because inflation is really high, and so they sell the inflation hedge. Huh? Tell me that again. Inflation is really high. The government can't get it under control, so there's a panic. So people sell the inflation hedge, and then the journalists and the modelers say, "Well, look, we've run a statistical model for the past week, and it shows that when inflation is high, people sell Bitcoin, so it's not an inflation hedge." Huh? Well, if you run the model over 2 years, and you look at it since COVID, you can see it's up 229%. And it's pretty clear that gold is not an inflation hedge, and silver is not an inflation hedge, and stocks are not an inflation hedge, right? And bonds are not an inflation hedge, and currency is not an inflation hedge. That's pretty obvious if you look at it over 2 years. But if you shorten your time horizon to 2 weeks, you can come to the opposite conclusion. But in my opinion, it's pretty foolish to come to that conclusion.
Michael Saylor is in for the long haul. According to him, if you're an investor, you should come to any conclusions only after analyzing the market for the time frame of at least 3 to 4 years. He also said that fundamentals are crucial and should not be ignored. So Saylor believes that Bitcoin will rebound and advises everyone not to panic. He also found it very foolish to come to any conclusion after looking at statistical models made for short time frames. He also points out that Bitcoin has seen a very nice jump in price rate since COVID. He believes Bitcoin is the best hedge against inflation. If we see from a long time horizon perspective, to conclude today, he really remains a vocal advocate for Bitcoin and cryptocurrency and has no intention of selling his coins. According to him, you should hold and not trade. That's it for today. If you found this video useful, be sure to subscribe to my channel. I'll see you in my next video.